All right, students, please open your textbooks, Summa de Arithmetica, to chapter 9. We're going to discuss double entry bookkeeping today. All right, that joke has not hit 3 times now. It's like 3 different times I've made that joke and everybody just kind of like, all right. Does anybody know who I am? You're the Grim Reaper, Dr. Barnes. Yeah, no, I'm not the Grim Reaper. So I'll show you if I can actually get to the site. And this guy right here. Okay. Friar Luca Pacioli, the father of accounting. He invented double entry bookkeeping. Yeah. She taught that in your 221 class, 220 class. I'm not teaching the important stuff. Yeah. I'm keeping the important stuff away from you. Yeah. So Dr. Keaton challenged me to actually dress up like this. And believe it or not, the Franciscan friar outfits are only like $30 on Amazon. So apparently it's not a real expensive costume, which makes sense. All right. So yeah, that's my costume for today. I'm not leaving the hood on. It is extremely hot in there. But yeah, thought you think polyester would be cool, but no, it's not. So happy Halloween, everybody, and hope you missed the fun part, Sadie. Yeah. You missed more. I was pretending to be Luca Pacioli, so yeah. So father of accounting. Yeah, there we go. Yeah. Although, yeah, apparently I'm spooky according to Professor Bergman. So yeah. So some quick announcements, just some reiterations of what I talked about on Monday. So please make sure that you're aware that we have a week before the Excel assignment is due. If you have not started working on it, now is the time. All right. Maybe not exactly right now, but in the very, very near future. Week after that is professional interaction is due. We do have the executive residence coming up next Wednesday from 4 to 5 p.m. And then we had did anybody attend the AI thing on Wednesday? Yeah, that was pretty interesting. It's fascinating. So that's a good one too. Also, I've been really, really bad about this semester. I'm usually on top of this, but I did finally finalize the groups for this for the presentation. So that's actually available online. If you go to the content folder and the course materials, you notice there's a project group assignments and it's got everybody allocated to a group. And I basically, if you wanted to be in a group of people, I put you in a group of people. Otherwise, I just kind of assigned you haphazardly, not truly at random, but basically where I thought there would be best fits. So next step is, and I probably shouldn't show this because I get accused of cyberbullying. So yeah, probably showing names. Yeah. So just as a quick note, for that, we still have projects and dates to select. So you need to confer with your group and say what topic area do you want to cover. There are 6 listed in the syllabus, so you need to select one of those. If one group selects one in advance of the other, then that one's cut off. There's not going to be 3 presentations on the same topic. So please take a look at that. Reach out to your group and say you're all comfortable with doing this one, and that's the project area you will be presenting on. And then just as a reminder, the presentations will take place in the last 2 class sessions. There will be 2 presentations on the Wednesday of week 15 and a presentation on Friday of week 15. That's the easiest way to break it down. If you have one that you can or cannot do for previous commitments, please make sure that you schedule on the opposite day and do that ASAP. I would hate to have to try to rearrange things after the fact, but please make sure that you're aware of that and start thinking in advance of that. I know that seems like week 15 seems a while off, but this is the end of week 11, so it's not that far off, even with Thanksgiving break counted in there. So I'd like to get that resolved pretty quickly. I'm going to keep pressing you to do that, or at least I'm going to try to remember to keep pressing you all to do that. Please keep that in mind. Reach out to your group members. If you are not in contact with your group members already, you can reach out to them through Brightspace. That's an easy way to connect to anybody in the course. So if you don't know somebody that's in your group. All right, now we have homework. And since, Friar Luca knew a lot, but he probably didn't know a lot about auditing. So Dr. Barnes is taking over for this one. So let's go ahead and work through the multiple choice, and then we'll start talking about some of the things. How'd you all find this homework? This is one of those ones that everything should start feel like it's coming together. If it felt foreign or lost, that's a problem. That being said, I'm not real fond of the next week's homework assignment. I've tried to improve it a few times, and the question base is just not there. So I'm not sure what to do with that. By the way, next week will be a very interesting week. Monday, we'll have a fairly short class session just because of the short topic area. Then we'll have a long class session on Wednesday, and then we'll have another short class session on Friday because the homework is pretty easy. So I made up for having an extensively difficult week this week by having a couple of short days next week. All right, so that's that to look forward to. And then the week after that is going to be extensively difficult again. So question 1012. For the control activities to be effective, employees maintaining accounts receivable subsidiary ledger should not also approve. All right, so the very first thing we need to identify is what process area are we talking about? And since we're chapter 10, we're probably talking about revenues, which accounts receivable is a big clue to that. So we're talking about somebody who actually maintains accounts receivable, so that's going to be a recording activity. We're probably talking about somebody should not have a responsibility area in another area of accounts, or sorry, in revenue that contradicts to that. So I want to go ahead and I want to knock out A and D because employee overtime wages would be part of the payroll process. Cash disbursements would be part of purchasing or specifically cash disbursements level of purchasing. So it's going to be B or C. And credit granted to customers, that's going to be an authorization step, and write off of customer accounts, that would also be an authorization step. So I've got two authorization steps there. So technically speaking, both of them could be correct answers. But which do you think is the more relevant of the two answers? This is something that we have to kind of think about. We have to use a little bit of judgment in this context. What is it that we're looking at? So if we're talking about credit granted to customers, that is authorization, but that's something that's early on in the revenue process, whereas accounts receivable recording is very end of the revenue process. So separation of those responsibilities is not as important as something that's really consistently close to the process. Write off of customer accounts would be right next up to accounts receivable recording. So basically, the write-off of customer accounts is one of those ones that I would say that this, since this is kind of an authorization step to approve the write-off of a transaction, this is where I'd say this is probably the most important for segregation of duties. Now, I wouldn't ask you a question that's not this clear. Like you say, there's two authorization functions. Dr. Barnes, which one are we supposed to know is correct? The answer is on the exam, it'll be a lot more clear. It'll be clear recording, authorization, and custody functions that you'll have to separate out. So this one's a little bit obscure, but it does still get the point across. 1013. Which of the following controls is most likely to help ensure that all credit revenue transactions of an entity are recorded? So if they're being recorded, what assertion are we dealing with here? We're trying to ensure that they're recorded. Full stop. Not recorded at the proper value, not recorded in the correct period, just recorded. What's our recording assertion is what I'm asking. It begins with the letter C, but that's so that's like three of the assertions. Completeness, yes, completeness. Okay, that's the one we're looking at here. So let's go ahead and take a look at each of the answers and see what we can come up with. Billing department supervisor sends a copy of each approved sales order to the credit department for comparison to the authorized credit limit and current account balance. All right, so what direction are we moving in there? What direction does that imply? So sales order, credit department, so the documents that are generated after approval of the account balance. So we're talking about later documents going back to the original source. So we're moving from top to bottom, all right? What do we call that when we move from top to bottom? What is that called? Vouching. It's called vouching, and it tests distance occurrence. So it's not that, it's not A, okay? What about B? Accounting department supervisor independently reconciles the accounts receivable subsidiary ledger to the accounts receivable control account each month. So there may be some small argument for completeness here, but it's more likely that we're trying to verify which assertion through this test, or which assertion is being addressed in this, not this test, but this control was addressing which assertion. Sounds more like VAA to me. Sounds like more like VAA. That's the risk that we're associated with. County department supervisor controls the mailing of monthly statements to customers, investigates any reported differences by customers. Okay, so making sure that there's proper custody of the monthly statements and if there's any subsequent differences that take place. So that sounds like we're trying to make sure that all of the items are valid, all right? Either valid or reported at the correct amount. So we could make an argument either for existence, occurrence, or VAA, but neither one of those could be completeness. So we got one left. Let's hope this is correct. The billing department supervisor matches pre-numbered shipping documents with entries in the sales journal. So documents moving up to the system. We're moving from bottom to top. That's tracing tests, or tracing relates to completeness. Okay, tracing is completeness. So that's basically what we would do there. So D is a control related to completeness. That's the intuition behind that. 1017. Accounts receivable turnover, credit sales divided by receivable, was 7.1 times last year compared to only 5.6 times in the current year. It's possible that there were what? So let's think about this. We've got a credit sales and receivable that went down from the previous year. So the turnover was 7.1 times last year and it went down 5.6. So this number decreased. What are the two explanations we could have for decreasing this number decreasing? So credit sales changed, but did credit sales go up or down? Down. And then receivables went up or down because the denominator up and moved in opposite direction. Okay, so we're looking for one of those effects. Now, if you look at A, there's an argument that credit sales could have gone up if there were unrecorded credit sales. Okay, or of course, credit sales go down if they're unrecorded credit sales. All right, but how likely is it that an organization is going to willingly not record sales? Is that a big risk that we're concerned about? Probably not. Okay, so it's not likely going to be A, even though that mathematically works out. It's not likely to be the situation. What about if there are fictitious sales in the current year? Okay, yeah, so that's going to generate a receivable, which is going to make receivables go up, which is going to reduce our receivables turnover. So keep in mind, you will never collect a receivable, so that's going to diminish the turnover because you've got all these accounts that are just sitting there forever. So that would be a clear answer. D is our answer there. 1021. The negative request form of accounts receivable confirmation, they're performed in combination with other substantive audit procedures, is particularly useful when what? So we talked about positive and negative confirmations, and we did it on Wednesday. It wasn't even that long ago. So which one provides more assurance? Positive or negative? Positive. So negative is going to provide us less assurance. So what are the conditions that we can be okay with less assurance? The assess level of control risk relating to the receivables is high or low? Low. Okay, so it's going to be A or B. All right. The number of small balances is high or low? High, because if it's something that we don't care if they report on, we want to make sure that it's going to be small balances. So we want all of our confirmations to be on small balances, or most of them. So high. So that's going to be A, but let's go ahead and look at this. Consideration by the recipient is likely or unlikely? Likely. We think that it's unlikely that the recipients will look at the confirmations and respond as appropriate. If it's unlikely, basically we're saying that there's a high risk that they would just ignore the confirmation altogether, which doesn't give us a lot of confidence about the negative form. So A is clearly the answer. It's got all the ones that are aligned up there. 1023, in evaluating the adequacy for the allowance of doubtful accounts. Stop. What did I say about allowance for doubtful accounts? VAA. Okay, thank you. All right. An auditor most likely reviews the entity's aging or receivables to support manage the financial statement assertion of. We didn't even need to read the rest of the question. We knew what the answer was for it, and it makes sense, okay? Because we're trying to make sure that we understand how the allowance for doubtful accounts is generated. We're going to look at the aging of accounts receivable to make sure that it's intuitive, it makes sense, and the valuation is correct, okay? The valuation is correct, so it's valuation and allocation B, which is VAA. So moving on to chapter 11. Gosh, I hate the Zoom bar. All right. 1114, when goods are received, the receiving clerk should match the goods with what? Okay, so let's just go ahead and look through this. The requisition form, we could do that, but first of all, that's not a requirement. Secondly, it's not sufficient on its own. Okay, so A is a possibility, but it's probably not going to be fully ingrained. Okay. Next, the vendor invoice and the purchase order. So it sounds like a great one. Sounds like we're doing a lot of document matching. What's the problem with B? What's the problem with B? Why can't we match to both? So when goods are received under a credit-based system, have we received the purchase order? All right, sorry, did we issue the purchase order? I should say, because we're on the purchase process, issue the purchase order. Yes, we have to issue the purchase order before goods are received. Have we received the vendor invoice? Doesn't make sense to say that we received the vendor invoice. They're only allowed to send us an invoice after they've shipped the goods to us, after they've met their required obligation to meet the goods. So even though we'd love to be able to match it to that invoice, that's not something that they're officially should be sending us. Now, is it possible that a vendor could send us an invoice ahead of time in advance? Yes, that's a very bad vendor right there. Okay, it's not a vendor I don't want to do business with because they're trying to say, hey, if you pay for this, we may not ship you the goods. Yeah. So remember we talked about that in AIS. We talked about NetSuite and had to actually have a mark saying that you couldn't bill in advance receipt. That's kind of the thing we're doing there. So vendor invoice is out. That being said, D is also out because vendor invoice is not going to be received yet. So we got C, the approved purchase order. That's the most likely answer, and that's the one's correct. Okay, it's going to be the one's correct. Now, could we also say that there are other documents that we could do additional matching with? Sure, the requisition form could be included here. It's not a requirement, but it could be. The shipping order could also be included as well, okay, as part of the receipt. But the one that we know that we want to match with is the document that originally generated the purchase in the first place. Something also I want to mention that might come up, but I do want to reiterate. So the book talks a little bit about how on the purchasing side, especially in receiving, purchase orders are left blank. All right. Why do you think that might be the case? Why would receiving receive blank purchase orders? So imagine you're receiving, okay, and the goods that are supposed to be shipped to you by the vendor are 10 items, okay? And this is a particularly liquid good that you could actually go on eBay or what's that Temu? Is that the name of that the newfangled place that you could go on and you could go sell it for a profit, okay? So you actually say you identify that and said okay, that'd be great. I'd love to sell that. I could use extra money. And so the vendor sends you 20 of an item instead of 10. And so you know that it's only supposed to be 10 recorded. Could you just take pocket 10 and then record that 10 was received? Yeah, that's certainly a possibility. Okay. So we don't want there to be a bias existing when they receive the goods. We want them to record exactly what was received. So they have to do the count and make sure it's correct. To a lesser extent, it could just be laziness. It's just like, does that look like 10? Looks like 10 to me. Okay. Or if you received 1,000, looks like 1,000 to me. Yeah. So that's kind of the argument that we make for blank quantities. Not something I'm likely to test on, but I do wanted to make that comment because that may come up. All right. 17. In a properly designed purchasing process, the same employee most likely would match vendor invoices with receiving reports and do what? So what step of the purchasing process are we talking about here when we're talking about matching vendor invoices with receiving reports? So presumably it's at a step where the vendor's invoice has been received. Okay, so later in the process, talking probably about before the accounts receivable has been recorded or payment's been issued. So what step was that called? Does anybody remember? Going to want to know this for the exam, by the way. Okay. So this is the invoice processing step. All right. Invoice processing step. So what are some things that we could do during the invoice processing step? Could we post the detailed account payable records? That's an interesting question. What did I say that invoice processing largely was? The majority of that, what was that functional area? What was it responsibility area, I guess I should say. So custody, authorization, or recording. Authorization. Yeah. Invoice processing was primarily authorization. For posting detailed accounts payable records, that's a recording step. Authorization and recording are conflicting in duties, so it's not that. What about reconciling the accounts payroll ledger? That's sounds like another recording step, which conflicts with the authorization. Canceling the vendor invoices after payment. Okay. That sounds like another recording step. So all of those are kind of conflicts with authorization points. Okay. Especially since we're talking about vendor invoices, payment has to actually take place for that to be the case, which would be a later step in the process. But what about recompute the calculations on a vendor invoice? You're trying to determine if you can properly authorize the payment to be made. Would you want to make sure that the vendor has actually done their math correctly? That they're charging you what they're supposed to charge you? Seems like just a good intuitive control to me, and it doesn't conflict with any responsibilities that you have. So I think B is probably the most intuitive, sensible, but there's reasons why the other ones are not. 19, to determine whether accounts payable are complete. What assertion do you think we're dealing with here? Existence occurrence, right? Yeah, good job. All right. Completeness. It's Friday. Did you guys engage in AYCD last night? That's what I accuse my graduate students of. Okay. They were really, really quiet today. Okay. Wait a minute. What is AYCD, Dr. Barnes? We've never heard that term before. Yeah, right. Sure. All right. Okay. Auditor performs a test to verify that all merchandise received is recorded. Seems good because completeness is our recording assertion. The population for this document of tests consist of all what? So what do you guys think? First of all, let's just think about this. We're talking about completeness. What direction are we moving? Top to bottom, bottom to top. Bottom to top, yeah. So you're gonna move bottom to top, okay? So we probably want to source document that's early in the process. If we're talking about merchandise received, what is probably a good source document that occurs early in the process? Receiving reports? Yes, you guys are on top of it. Okay. So starting with receiving reports and going to the system to make sure it's properly recorded. That would be a good set of source documents. Now, if we wanted to make sure they properly exist, would we probably start with the receiving reports, or do we start with something that's more system relevant? Probably something later in the process where the recording took place and making sure we can check and see that the transactions actually took place. So we would look at probably, I would say, something beyond vendor invoices. So we could actually look at the general ledger or the subsidiary ledgers, start with those and move back down to the receiving reports to see that these items that have been recorded have actually been received. But yeah, the assertion does matter. And we're talking about we want to go in an early process and merchandise received is recorded, go to the receiving reports. All right. Question number 20. Which of the following audit procedures is best for identifying unrecorded trade accounts payable? Now, there's two ways to answer this question. First question would be kind of like say, I don't know, Dr. Barnes. That's not familiar to me. Have we even done that? Okay. Second question would be, would Dr. Barnes ask this question if it's something we haven't done? And think about it. Did you all do any identification of unrecorded trade accounts payable? Give you a hint. The answer is yes. You did a search for unrecorded liabilities, okay, which is just a fancy way of saying that. What did you do as part of your search for unrecorded liabilities? Well, let's go through the answers, and you tell me if this sounds like something that you did as part of this process, okay? Examination of unusual relationships between accounts payable balances and recorded cash payments. Did we look at relationships? No, not really. Reconciliation of the vendor statement to the file of receiving reports to identify items just received to the balance sheet date. So do we go to the vendor statements? Did you all look at that for your assignment? Nope. Okay. Investigation of payables recorded just prior to and subsequent to balance sheet date to determine whether they're supported by receiving reports. You all actually did that for your homework, but it was not part of the search for unrecorded liabilities. That was what type of testing? That's a cutoff test. Okay. Review of cash disbursements recorded to subsequent to the balance sheet to determine whether the related payables apply to the prior period. Well, we only have this answer left, so it better be correct. So did you all do this for your homework assignment? You absolutely did this for your homework assignment. That was part of the Earthware Clothiers assignment for search for unrecorded liabilities. So that's effectively what you did, and that makes sense because that's the answer, okay? Question 23. When using confirmations to provide evidence about the completeness assertion for accounts payable, the appropriate population most likely would be, so I felt bad about some of these challenging questions, so I gave you an easy question, all right? If we're talking about the purchasing process, what party do we reach out to when we're talking about that? So we as auditors are talking to a third-party entity that does business with the client. If we're talking about accounts receivable, what group of individuals will we reach out to? What is the group of that party, the people that buy from our client? Also begins with the letter C, but it's not client. Customers, yes, customers, okay? We're talking about the group of individuals that our client buys from, they purchase from. What would that group of entities be called? Suppliers or vendors? Yes, vendors with whom the entity has previously done business. Yes, that's what we're identifying. All right, moving on, 1026. Oops, that's not 1026. Okay, let's try this. All right, so this one's pretty good. It's not great. Well, actually, this one's really good. And then we've got some questions like this, problems that are in future chapters that are not nearly as good. But basically, you have a series of audit procedures here. And then below this, we've got a series of assertions. Now, I want you to note that there's assertions listed for each of these examples, okay? And you have to identify the audit procedure. F does not have an assertion tied to it. That does not mean there's not an assertion. It means for the past 3 editions, they included this new question and they failed to put an assertion associated with it, even though I'm sure that I've told them like 3 or 4 times this is missing, which shows you how much McGraw-Hill values my input. So what is the assertion that we're talking about here? What is we're talking about? Revenue related disclosures are made of the financial statement. That's presentation. Yes. Okay. So by the way, it gets a little bit muddled later on. Sometimes they tried to put their assertions on there and they don't, the people who are editing the book aren't sure what assertions are. So they just list a whole bunch of them. So it'll get a little bit muddled, but this one's a pretty good one. So what we're going to be doing is we're going to be identifying the audit procedures. What I'd like to do to start out is just kind of review, let's see, what would be the easiest way to do this? Okay. So let's review the assertions and talk a little bit about what it is we're looking for, and then we'll identify the audit procedure. So ensure the entity has title to the accounts receivable, which is rights and obligations. So we're trying to make sure that the legal title for a particular item for accounts receivable is held by the entity. Now, we talked a little bit about how the entity could sell their accounts receivable. They could factor those. We want to make sure such factoring does not exist. So we're actually going to be looking for documentation. So there's a couple of these that relate to documentation. We got review of bank confirmation loan agreements and review drafts of the financial statements. Of those two, which do you think would be most appropriate for this particular situation? Number 1, reviewing the bank confirmation loan agreements, because we want to make sure that any transactions that take place, we want to be able to possibly identify, particularly those of selling the accounts receivable or the collection of the accounts receivable, even subsequent to that. All right, B, determine the recorded accounts receivable include all amounts owed to the client. Okay, so this sure, let's see, what do we got here? This sure sounds like completeness because of that. So when we talk about completeness, we already talked about direction. What direction are we moving again? Bottom to top. Got that one. All right. So yeah. Which of these actually represents a tracing test? So we have select a sample of shipping documents, match them with the related sales invoices, and determine they've been included in the sales journal and the accounts receivable subsidiary ledger. So sales invoices are a source document. We move up to the system and make sure they get recorded in the system. So that sounds like completeness to me. So 3 sounds good. C, verify that all accounts receivable are recorded in the correct period cutoff. So probably going to do a cutoff test to test cutoff. What do you guys think? Does that sound intuitively correct to you all? Yeah, so select a sample of shipping documents for a few days before and after your end. That's all there is to it. When you see cutoff as an assertion, you say probably a cutoff test. That's really all you need to know. Ensure the allowance for uncollectible accounts is properly stated. Okay. What is that thing that you use to generate the allowance for uncollectible accounts? What do most organizations still use? Even though we've been computerized now for 30 years, most organizations still use a very simple protocol for this. It was actually on the first exam. I showed it to you in the first exam. It said 0 to 30, 30 to 60, 31 to 60, 61 to 90. What is that called? AR aging. Okay, aging for accounts receivable. So we're going to review the aging accounts receivable with the credit manager. Okay. Confirm the recorded accounts receivable are valid existence. So we want to confirm that the accounts receivable are valid. So if we want to confirm something, what would be a great test to confirm something? A confirmation. So you're saying that confirmations confirm things. Yes. Confirmation of accounts receivable. By the way, this is a fairly intuitive question because they use the word confirm. But would confirmations be appropriate for testing existence occurrence of accounts receivable? Yes, they would. Okay. That is our primary concern, that primary assertion in this area. And that would be a very, very easy way. Now, let's switch up the question just a little bit. Is this the only assertion that we'd be able to test with confirmations? No, we could actually test multiple assertions simultaneously with confirmations. I would primarily be concerned with existence occurrence, but we could test completeness, we could test cutoff to a lesser degree, and we could actually test valuation allocation accuracy. So confirmation is very versatile in that regard, but primarily going to be existence occurrence. All right, last one, ensure that all revenue-related disclosures are made in the financial statements. Probably want to look at the financial statements, so review for drafts of the financial statements. All right. 10:30, I think I've got a spreadsheet on this, so. Sounds like you've got spreadsheets for everything, Dr. Barnes. Like, yes, I do. I live through spreadsheets, live vicariously through them. So, did I put that in the homework files? That was down there. Oh, there we go. There, problems trying to I knew I wasn't losing my mind. Okay. All right. So the dates are a little bit off, but that's okay. That's okay. So basically what we have here is we've got some looking at shipment of inventory, and it's important to note there's a few things that we need to be aware of. So first of all, the merchandise shipped to customers is up to December 30th. So anything that takes place after December 30th has not been shipped to the customers. So we're going to be looking at December 30th, and that's basically, when we say that, that's basically saying the cost of goods sold side of the sales transaction has already been recorded. So remember back from 220, when you did a sales transaction, you had two parts. You had the sales transaction, which was the AR, debit to AR and credit to sales. And then when you had the cost of goods sold debit and the inventory credit, there were two parts to that transaction in a merchandising environment. This is saying that the cost of goods sold side of the transaction has been recorded for everything up to December 30th. Who thought we weren't going to use double entry bookkeeping today? Isn't that great? Great. It's appropriate. Yeah, there we go. All right. So that's important to note. Also, it says that all sales are made FOB shipping point basis, and we're going to assume that all purchase invoices have been collectively reported. So what we're doing is we're looking at transactions just a little bit before and a little bit after to see if they're properly assigned to the current period. So these transactions have been assigned to December. These transactions have been assigned to January. All right. So sales amount of the invoice has basically been recorded as $3,000 on December 21st, and the cost of merchandise sold is going to be, I'm going to have to make this a little bit smaller so I can fit everything on here. It's $2,000 on December 31st. So what do y'all think on the sales side? Does the sales side seem appropriate to be recorded in December? Yeah, okay, the transaction took place in December, so it makes sense that it gets recorded in December. Do we need to have any adjustments for the cost of goods sold side? So remember, it said that all transactions up to December 30th have been recorded. This is December 31st, so this does need to still be recorded. So we would have a cost of goods sold side of the entry that just need to be recorded. That's what this is telling us. All right, let's look at B. We have a sales invoice for December 31st of $2,000, then a shipment out to the customers on December 13th of $800. All right. Do we have any problems with this transaction as a whole, both sales or cost of goods sold side of the entry? They both properly belong in December. And because this took place on December 13th, they got recorded on December 30th. So we're good with that. Is there something that you'd want to bring up as an auditor here? Not necessarily an adjustment, but something you'd have a question about? So are these the same date? No, they're pretty different, radically different, like 18 days. Why would you record a cost of goods sold to a customer on December 13th and then 18 days later not fail to record or wait until record the sale until that date? So you'd want to figure out what was going on there. It's probably not anything serious. It probably just something that was overlooked, but that would represent a control weakness that you might want to investigate further. All right. Recorded transaction for $1,000 on December 29th and $600 of say cost of goods sold on December 30th. Anything about this transaction jump out to you all? I think it's fine that both sides should be recorded in December. This has already been recorded. We don't have to make an adjustment because it's December 30th. All right, now we're getting to the interesting ones. Got a sales transaction on December 31st and a cost of goods sold transaction on January 9th. Okay. So it was shipped on January 9th. That's kind of the important point. Should this been recorded in December of the current year? I'm going to say current year because my year is probably different from yours since I created this a while back. So if it was shipped on January 9th, it belongs properly in the next year, not in the current year. So if they recorded this transaction, we need to reverse the sales transaction. So, I probably should be highlighting my answers down here. My apologies. All right, so for D, we'd have a really, really weird adjusting entry. Sales revenue gets debited, accounts receivable get credited. And I know you're kind of silently screaming to yourself, says, Dr. Burns, we never debit sales revenue. We do when the original transaction was incorrect, okay? This is a reversing entry because the transaction was not recorded properly. It was recorded early. It looks like somebody was trying to bump up sales, not items, and then just subsequently shipped. This is an example of a bill and hold sales fraud type thing. Or at least that's what I would assume in the scenario. All right. Then we have $10,000 recorded on December 30th, and then goods shipped on December 29th for $5,600. So looks good, right? Everybody's good with that? There's a little star there. Has anybody noticed a little star there? There's there's a star on that. And it said ship to consignee. So what does that mean? What is a consignee? I was hoping you'd tell me, Dr. Barnes. You're the all-knowledgeable father of accounting. Yeah, that's true. Yeah. So that's what it says on the badge. All right. So what is a consignee? Consignment basically means that we've got a third party that is handling sales for us. It would be like eBay or Temu, like I was mentioning earlier. Another party handling sales transactions for us. They don't actually have ownership or custody of the item. They're just facilitating the sale. So if that's the case, who has ownership of the inventory? We still do, okay? So we can't actually record a transaction associated with that. So we'd have to reverse the entire transaction. That's basically what that's telling us. All right, moving on to the next part. So these are all transactions that were recorded in the subsequent year. So we got a sales transaction for December 31st, and then a shipment transaction on December 30th. Should this have been recorded in January, the subsequent period? No, this would be properly recorded in the period under audit. So for mine, 2021, for you all, probably a later year. So we need to record this transaction. Now, the good news is we only have to record one side of this transaction. We only have to record the sales revenue side because we know that since it was shipped out on December 30th, the cost of goods sold side of the transaction's already been recorded. All right, G, 4,000 on January 2nd, 2,300 on January 2nd. Any problems with this transaction? Nah, this transaction looks good. This transaction looks good, so no changes to this transaction. And then H, so $8,000 on January 3rd, a shipment of $5,500 on December 31st. So if we shipped it out on December 31st, when should this transaction be recorded? The period under audit or the current year? The period under audit. I say current year because we're currently in January, so I should probably just use the years. I know it's different for you all, but it's not going to be January, it's going to be in December because it was shipped out on December 31st. So we'd actually have to record both sides of the entry. We'd have to record the sales transaction and we'd have to record the cost of goods sold transaction because this was shipped out on December 31st and cost of goods sold were not recorded they were only recorded up until December 30th. So interesting analysis. Something that you're probably not familiar with is this separation of cost of goods sold and sales transactions, but it's kind of an interesting activity to go through. What you guys think of cutoff? Do you enjoy the cutoff analysis? Hopefully you said yes, because we're getting ready to do more. All right. So let's go ahead and move on to the one in chapter 11. All right, so you're engaged to perform an audit of Giordani Company for the year ended December 31st, 2018. You decided to perform cutoff testing for payables and accruals. So we're selecting all items greater than $25,000 for 2 business days before and after year end. Now, the most important piece of information is that you actually needed to know what the last receiving report number is. And the last receiving report number was 49745. Why is that important? Are we to assume that receiving reports are sequential? Probably makes sense. That's what we would hope for sequentially numbered documents. Everybody remember NetSuite when we would have pre-numbered documents, we'd say they'd happen in sequence. So something that actually took place before 49745 should have occurred in the current or the period under audit. Something that was recorded after 49745 should occur during January. So the January 2022 for me, January 2020X for you all, whatever that is. All right. So that's something we need to note, and let's go ahead and use that to move forward. So I'm going to zoom out on this one so I actually have a little bit of space. Okay. So under 1230, we have receiving report number 49742. Any problems with that so far? No, it looks good to me. So amount for 2975 chemicals purchased for manufacturing process. Is this properly recorded in the period under audit? I'd say yes. And I'm right. Yay. Helps having the solution manual. All right. What are we going to do next? We're going to do B, consulting with no receiving report numbers. Anybody have a problem with that? So what does consulting imply? Services. Do we receive services? We kind of do, but would the warehouse receive services? No, it'd be wherever the services are rendered. Let's look at this, okay? Payment for consulting services for the 3-month period beginning December 31st, 2021, the $45,000 was charged to consulting expenses. Seems legit. Any problems with that? This is where your 220 instructor be screaming, says, yes, there's problems with this. Come on, remember financial accounting. So what do we know about anything that's a prepaid expense? Gets allocated on a periodic basis. If it's $45,000, that means for a 3-month period, $15,000 per month. But they booked it all immediately to be expensed, consulting expenses. So we need to reverse that entry and put part of it back in a prepaid expense so the 2 months can be recognized in the next year. So let's go ahead and look at this journal entry. I know I had you debit revenues earlier, and now I'm having you credit expenses. Isn't that crazy? Teaching you bad accounting practices. Father of accounting, indeed. Yeah. All right, 1231, 49744, golf materials, raw materials recorded in the manufacturing process. Anybody have a problem with that transaction? I'm absolutely happy with that transaction. So let's go ahead, say no adjustments necessary. All right, moving down to the next year. So January, we have 49746. 75, 985, purchase of a new forklift. Seem legit? It is, as MC Hammer would no doubt say, too legit to quit. I'm glad you laughed at that because I was afraid that I dated myself with that particular joke. All right. 49743, pack products of 42,000 for paper products used in the manufacturing process. Any problems here? Yeah, so what's the problem with this? So receiver report number is too small, okay? It's 49743. If it's a sequential process, it should be something that we know took place in December, so it should be recorded in December. So how are we going to record this transaction? How you record it really doesn't matter. The book actually uses this as the recording, which I actually hate this recording because this is not supplies. These are products that are going to be used in production. So I would say this is raw materials or raw materials, but this is actually the book's answer, which again, this is just me complaining about McGraw-Hill never taking my feedback. But what's so much to be listened to? All right. Then we have January 2nd, none on the telecom bill. So this is utility. So this is a service. We wouldn't receive that. So 32,450 December 21st or 2021 telephone bill or December whatever telephone bill you had. So yeah, that's a big telephone bill. But if they've got a big company, that probably makes sense. So any problems with this? Everybody's like, I don't want to nod my head because if there's not a problem, I'll look silly. But I think there's a problem. I'm just not sure what it is. It is a problem. What do we know about the matching principle? What do we know about expense recognition with respect to the matching principle? It gets recognized in the period which the related revenues occur. So this is expenses related to December 2021 revenue generation. So it should be recognized The period incurred. Remember 221, remember cost accounting, that whole thing about having to allocate overhead, and why do we have to go through that process of allocating overhead? Why don't we just wait to recognize the revenue in the subsequent period? The answer is matching principle. That's the whole reason that Dr. Otero has a job. Yeah. He's a lot more valuable than that, but let's be honest. Let's be honest. Cost accounting, yeah. She threatened to make me the cost accounting professor when she retires in a few years. So I'm going to eat my words. Everybody's going to be kind of like saying, "You made fun of cost accounting, Dr. Barnes, and now you have to do it." It's like, yeah, I deserve this. I deserve this punishment. Okay, EWC assignment, search for unrecorded liabilities. So you had your account balances right here, and then you had your testing that's going to occur right here. So basically what you had to do is you were going to use these items down here. What are these called down here, by the way? It's called the legend. You're right. What are these symbols called? They're tick marks. Tick marks, yes. Remember we learned about tick marks back from documentation? Yeah, shorthand notation. So using these tick marks, and we only had one or two that we had to deal with. Trace the December accounts payable listing, okay, which means that we found it, or the delta signal, the triangle, flag for further analysis and review, inquiry review. Now, be sure and note, this is really important, and I'm going to emphasize this really heavily. If we find a problem, this is not saying that there is an unrecorded liability. This is saying that we've identified something that could potentially be an unrecorded liability. That is why that wording is so important, because we're trying to identify something that possibly represents an unrecorded liability, so we're going to investigate it further. Okay, and that's something you should hold on to for the exam, because if I say that, I'm not saying that an unrecorded liability exists. I'm saying we're trying to identify if one might exist. Okay, so I'm just going to start putting in symbols, and you tell me what I should do differently. Okay, so let's go ahead and go. Let's go with this circle with a slash symbol right here. We go to that for apparel concepts. No, had a problem with apparel concepts. 254.32. Let's take a look. Okay, apparel concepts. 437.032. So their balance was 400 something thousand dollars. They paid about 60% of that. How do you feel as the client if your customers are paying you, they're not paying you the entire balance? How dare you pay me the entire balance or else? Is it possible that they could be paying part of it and plan on paying part of it later on? Yes, I'm fine with this. I am fine with this. Okay. Evaluation is evaluation is good. So we're going to go ahead and say this is good. All right. Can I go ahead and just go ahead and put this in here as well? What about the next one? We good with that one? All right, Lewis Hardware. I'm going to go ahead and put in that symbol for Lewis Hardware as well. Everybody good with that? No. Okay, Lewis Hardware. What does that need to be? Does it need to be footing? That's what the F stands for. The S, scanned and reviewed? No, we need to put a triangle there. We got a problem. Why is the problem here? Well, let's take a look. We don't know why there's a problem. Let's go ahead and just ask the sheet. Where's Lewis Hardware? There are no L's in this listing. There's no company that begins the letter L in this listing, which means that they don't have an outstanding balance. This vendor does not have an outstanding balance according to our client's records. So we ask the question as auditors, why are you paying them money if you don't owe them money? We just like giving money to our vendors to make them happy. You know, we thought that $20,536 specifically was just the right amount of money for a Christmas gift. It's not a good solution, not a good solution. So we need to investigate this further. All right, what about MS Leather Factory? Actually, I gotta say that sounds like an 80s rap band right there. MS Leather Factory, or hip hop or pop group, not necessarily a hip hop group. Okay. Stevenson Promotion. What do you guys think? That right there? Nope. This right here? Yeah, okay. By the way, you notice there are two tick marks. These two tick marks were used already down here, but I didn't want to leave that out. So we got a triangle here, which means there's a problem. What's going on with Stevenson Promotion? Stevenson, oh, they're here. But they're only owed about $69,000, and our client paid them $157,206. So what does that say to you as the auditor? Say, I want to know why you paid them $90,000 more than what you actually owed them. That's really a nice Christmas gift, but I don't buy it. Okay, I don't buy it. So that's what we're going to investigate further. All right, CNS Manufacturing Incorporated. Were you okay with the circle there? What about Intermountain Gas? I'm just going to put the triangle here. Just note that you have to do that. So what's going on with Intermountain Gas? They don't begin with the letter L, but they begin with the letter I, and it's not the letter I that's listed there. So we got two entities that are not present in the listing of amounts owed to vendor balances, and they received payments. And we've got one entity that received a payment much larger than what they were owed. Both of those are problems, okay? Again, if there's a payment that's exactly the right amount, or if there's a payment that's less than the amount that balance owed, we don't care about that as auditors. We're only concerned about the latter two, when there's payments in excess or there's payments to something that's not owed money. So what would your evaluation here be? So we've got three items here. What would be the reasons that you want to actually identify? So it says select the reason best describes the transaction, and you have to provide the vendor payments that's on the cash disbursement does not tie to the accounts payable listing, or you have to say the vendor accounts payable listing does not appear on the cash disbursement listing. So one of those two, I think for the first and one and the last one, this one here. And maybe I read that wrong. So vendor payment on cash disbursement journal. Okay, vendor payment on the cash disbursement journal exceeds the account payout bills. That's accounts payable listing. Those are really the only two situations that we're concerned with as auditors, and those are the ones that we list out in explanation. Again, just to reiterate, because I have a few minutes, just to reiterate, this is not saying that an unreported liability exists. This basically says we want to understand why this payment was made. There could be a completely legitimate reason. For example, if you look at the dates on the transactions, this one right here is 9 days after the period end. There's an entire possibility that there was a payment made within that 9-day window for a transaction that occurred during January. That's what we want to find out during our investigation. All right. All right. With that, have a happy Halloween. See you all. Have a good weekend. See you all on Monday for chapter 12.